Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is January 18th edition of Market Outlook. Don't forget to sign up for this at www.marketgauge.com. Well, certainly a volatile week. We ended up down, pretty decently. Nice recovery on Friday. Let's get into the charts. We got a whole bunch of interesting things to look at. First of all, spiders. Key index. First thing to notice, market moved up, closed right at that cyan line, which is the 10-day moving average, which is downwardly sloping. We did stop at a critical area where we stopped in early December. Also to note, rumors of plunge protection team out on Friday as Greek debt Greek banks clearly in trouble, along with the Swiss National Bank withdrawing its peg. You've got a whole bunch of factors that definitely roiled the markets this week, but ended up on a good note. Not only that, really nice volume, almost double the normal volume in the spiders, not quite, so pretty good action. Ended up 1.32%, and this year so far we're down a couple of percent in the S&P still for the year, but yet a nice recovery. So key point to watch first is the lows put in on Friday, and maybe just a tad lower, so that would bring you to the 198 level, which would then force a test pretty much of the 196.72 level, let's say the 197 level, which is also critical because that's where you had the breakaway gap above the 50-day moving average. So we definitely want to see this market hold, worst case around that 200-day moving average. So that should offer some level of support. On the other hand, this whole thing could be looked at as just a sideways consolidation pattern, looking at the top of the channel here, which is around the 209 level, and obviously the recent lows put in around that 198. So again, bunch of critical points. Would not like to see this thing penetrate the 200-day moving average. Okay, let's take a look at a couple of other instruments as well. Let's take a look at IWM. IWM had a clear test and a rejection of that 200-day moving average, bounced off it nicely, had a pretty strong rally, up 1.5%, was the leading index. So again, holding its 200-day, in this case, even a bigger consolidation pattern that we've been talking about, and you're basically pretty much sort of in the middle of it. But again, key level would be that 121.60, the top of that Bollinger Band. But meanwhile, again, holding. Would not like to see this break that 114 level, or even a little bit lower than that, which was the stab below it back in December. So that's a critical level. Otherwise, just in the middle of this consolidation range, that nice bounce off the 100. Again, you're straddling the 10 and the 50 to the upside. If we can get above that, I think you're going to potentially have a shot at least testing the 120 level to 121. And then from there, we have to see what type of power it has to get through it. But this is also a good index to watch as well. The weaker index is the Qs, which really traded beneath the December lows early on Friday, and did bounce. It is up 1.2%. It's more, it's further beyond its 50-day moving average, and clearly is showing the most signs of being tired. and really didn't have very much volume on Friday. So that's another cause of concern. Let's take a look at a couple of other things. Let's look at GLD. Gold. The only thing you can say about gold is we have broken out now above the 200-day moving average, and actually the more telling chart is the weekly. Let's go to this weekly chart and see what I'm talking about here. First of all, on a weekly basis, we've had on the breakout some of the strongest volume we've had in well over almost a year and a half. So that is very, very critical information right there. This is a strong rally, and it's taken out its 65-week moving average. This is the 200-week, the green here, up over 143. But meanwhile, we've taken out that key moving average. But I have been pointing this divergence out between stocks and gold over the last couple of weeks, which is interesting, the beginning of this year. And the key thing is, if you look at, let's put in a trend line here, or a horizontal line. Notice how this is really a critical level. You can actually move it down a bit if you want, right to this level here. And you can see how this swing level we took out, we bounced sharply off of that 114 level, just a little bit higher, again over here. Once we blew through it, it sort of cleaned out all the real die-hard longs. And it looked like gold, and the prediction was gold was going to get down to 1,000 or lower per ounce, which would be the equivalent of about 100 in GLD. What happened here is we flipped above this critical level that, let's see what exactly that is, around the 114.70 level, and have been trading above it now for the last 2 weeks. That's pretty critical information, because what has happened now is that you flushed all the longs out of the market, and now they have to get back in. Plus, we've moved back above this 65-week moving average as well, which is an important moving average. So it looks like gold is bottoming. Again, very strange, because when you take a look at copper on the same basis, and then we'll take a look at Freeport-McMoRan, really a great bellwether stock. You can see copper has really taken it on the chin, and worse than that, actually a better chart is Freeport. And you can see Freeport on a weekly basis is at its lowest level. This is a pretty good indicator, this stock right here, of the state of the copper market and the global economy. Freeport definitely at levels not seen since 2009. So clearly this gold-copper ratio is interesting to note. People moving back into gold and at the same time liquidating copper. So not good signs for the overall global economy, yet people are rushing into an alternative currency. That needs to be noted. Another thing, let's take a look at junk debt. Junk debt, as you can see, under its key moving averages, and even though it was up marginally on Friday, this is a weekly chart here, you can see that junk debt well under its moving averages, trading down basically in a negative fashion. We had pointed this out a couple of weeks ago. I'd really like to see it now take out this 39 level. It may show signs that the pressure on the junk debt, specifically the huge amount of bonds and related to the oil patch, might be alleviating on some of the pressure there. But meanwhile, it's definitely under pressure. Now, when you compare that to the TLTs, which is just explosive. TLTs basically closed on new all-time highs. So even after or during the financial panic, when the Fed had its gas pedal to the floor, right, trying to spur the global economy and the U.S. economy, we're trading much lower in terms of absolute rates or at those levels. So that's a huge difference when compared to that junk debt, right? Let's go back to that junk debt, and then you can see that the junk debt is basically, on a relative basis, having quite a bit of trouble. So again, before the financial crisis, junk debt was trading a good 10 to 15% higher from here. So as you see, rolling over and not acting well. All right, a couple of other things to note. We looked through gold, copper, junk debt. Oh, let's take a look at FXF. This is the Swiss franc, just to show you what can happen with incorrect position sizing and using tremendous leverage, especially on these famous currency trades. Look at this. Market opened up, was trading down to 95. It opened up almost 15, 20% higher. But in a currency that's 30 times the average daily range. That was enough to wipe out one hedge fund. It virtually lost 800 million overnight. You know, this is what happens with highly leveraged trades. Note of caution, this is not something that normally happens, maybe once every 10, 20, 30 years, but it does. And hence, the risk of ruin is tremendous. So position sizing is absolutely critical. But this is also interesting that the Swiss has decided to decouple from trying to keep its currency pegged to the euro. They may be suspecting that the euro is going to have further trouble. That's something to definitely keep an eye out on, and also adds to the overall uncertainty. So again, while the overall trend, going back to the U.S. markets, you really can't argue about the longer term trend, well intact. You can see again the 65-week moving average well intact. The last time we attacked it last year, handily bounced off of it. Longer term trend intact. That doesn't mean that we're not at an intermediate term turning point. I am concerned at the volatility still remaining overall high, and these triple point moves in the Dow underscores that as well. Okay, I think that gives you a good overall picture. To absolutely stay frosty, it's a little bit unclear as to what's going to happen. Price action determines all. Watch those levels in the S&P and the key indices, that junk debt for clues, and we'll see you next week. Thanks, and bye for now.